Thank you very much for the opportunity to speak. Central Asia Metals, some would ask, why are we here at investing in mining in Indaba for Africa? We're actually a diversified base metals producer. We have an asset in Kazakhstan producing copper, which we've been operating since 2012. We also have an exploration project in Kazakhstan, Shuak, which is throwing up some very interesting copper grades. Most recently, at the end of last year, the panel earlier were talking about M&A. We actually bought a mine in Macedonia, an underground lead zinc mine called Sasa for $402 million. And it's one of the largest M&A transactions that happened in the small mining space last year. So as we speak, we're currently a copper, lead, and zinc producer. Now, the company listed in 2010. We raised $60 million on the AIM market. We started construction of a project in Kazakhstan immediately, and in early 2012 we started producing copper, and at that point, not many months after starting production, we started a dividend policy. Now that set us apart from many of our peers at that time, and since then, since 2012, we've produced copper extremely profitably from our asset in Kazakhstan. We've paid dividends to the tune, towards the end of last year, to $105 million we paid back in dividends. That's given us a very strong stock price, and that enabled us to undertake the acquisition of the Sasa asset in Macedonia with a mixture of new debt and an existing stock. So you can see the timeline that we've enjoyed. Steady production growth. We now produce 14,000 tons of copper at an average C1 cash cost of about 50 cents per pound. Very good EBITDA margins, great free cash flow, $105 million paid back to shareholders, and bear in mind we only raised $60 million at IPO. How's that translate into share price performance? You can see the top left-hand graph there, our share price in the blue against the copper price. As we all know, since 2010-12, copper price has dipped to a low in 2016 and then on and up. But you can see generally the policy of paying a dividend to shareholders has paid back in our share price. On the top right-hand side, you can see, again, our share price against the AIM Basic Resources Index, outperforming quite handsomely. Our stock price at the moment, just over £3.20 per share. We have a market cap of over £500 million. But on the bottom right-hand side, you can see the shareholders that we have on our register. And I think the BlackRocks, the Fidelities, Mercedes, and the like are testament to the company and how we've developed the company over the years. Now, in Kazakhstan, we recover copper from some old mining waste dumps around an old Soviet-era copper mine that operated for over 70 years. It dumped the waste product on surface. That waste product has a low mineralized content of copper, running at about 0.1% copper. We did a lot of test work in the early days between 2007 and 2009 and showed that we could recover copper profitably from an irrigation system followed by an SXEW recovery, designed, I might add, by a Chinese engineering institute very cost effectively. Production, we've grown since we started. We now produced last year 14,000 tons of cathode copper at an average C1 cost for the first half of last year about 45 cents per pound. You can see that steadily, quarter on quarter, our production has grown. We've invested back into the project from our own cash flow a further $26 million, such that we've sunk to date about $70 million. And so towards the end of last year, we were fully invested in that project, and we have no major investment requirements going forward. The life of the project will go out to 2031, 32 or thereabouts. Now in country, we've picked up an exploration program at Shuak. This is throwing up some very interesting results. We aren't yet ready to publish these results to the market, but we're seeing oxide mineralization, surficial material, and we're seeing deeper sulfide mineralization as well. And we hope to spend another $2 to $3 million this coming year on exploring that. Now, a major acquisition towards the end of last year was a Sasa lead zinc mine in Macedonia. It was bought for a total cost of $402.5 million. And you can see on the table on the right-hand side how we financed that. There was $120 million of new debt provided by Traxys, our offtake partner at Kunrad. There was a rollover of debt existing in the asset of about $67 million. And we raised new equity in the market of $153 million, and that incidentally was the third largest equity raising in the mining sector on the exchange in London for last year. There was a consideration of shares to Orion Mine Finance, who were the major shareholder in Sasa, of a further $50 million. So you can see there wasn't too much dilution on the share issue of shares. The debt is easily manageable. When we did the deal, the net debt to EBITDA ratio was about 1.6, and we would hope with the metal prices as they are today, to that ratio to come down to 1 or below by the end of this year. The mine at Sasa has been going for a number of years. It is fully developed. Most of the capital is sunk. The major development headings are in, shafts are in, processing plant, all the necessary infrastructure to operate a mine, but most importantly, the labor. Quite often when we see new mines being produced, be they open pit or underground, one of the issues that people don't always spend too much time on is how are we going to operate the thing. We have over 700 employees on site, and they've been working there in some cases for over 20 years, so we have a lot of expertise there. The cash cost, this is why we bought the asset. Given that we have a very low cash cost producer in Kazakhstan, throwing off very good margins, EBITDA, and allowing us to pay a handsome dividend, which up to now has run at 6-7% yield, this asset has a zinc equivalent cash cost of about 39 to 42 cents per pound. Now, compare that to the spot price, which is near $1.45 or thereabouts. You can see there's a very good margin here. And this is one of the reasons we purchased this asset, because the cash costs, the margins, the ability to have a good, strong EBITDA allows us to pay off the debt, but also to maintain a dividend payment to shareholders, which predominantly our shareholders are very much in favor of, as you would imagine. It also has a 20-year mine life. It produces on an annual basis around about 21,000 tons of zinc in con and about 29,000 tons of lead. And actually lead, given the price rises, is actually a greater contributor to the overall revenue of the asset than the zinc at the current time. So it's got stable head grades, lead and zinc. It's got stable production. The top right-hand graph there, you can see that output from the mine has averaged between 780,000 to 800,000 tons per annum. The production of lead and zinc has been very consistent over the last 8 years. So you can see that it is a well-established, well-funded operation that we certainly continue to look to explore. There are some areas of the mine that still have additional ground that we can drill out to increase our inferred material. How does the asset look added to Kounrad? You can see from these graphs here that this asset on a copper equivalent basis has taken us from a 14,000 ton a year producer to about a 35,000 ton a year copper equivalent producer. Cash costs, still, if you look at the copper equivalent, we're talking around about the 70 cent mark, copper equivalent cash cost. So where does that take us? You can see now that we've paid back $105 million. We certainly intend to increase and pay more dividends this coming year. How is this performance when based against our peers? You can see on the bottom right-hand side, on a total shareholder return basis, we've averaged 20% per annum since we listed. So you can see that we've been a good, solid investment for our shareholders over the years, and we certainly continue to be so. And with that, thank you very much indeed.